All right, things are spiraling fast. The world's two biggest economies, locked in a showdown that's starting to feel less like diplomacy and more like a high-stakes collision course. No one's walking away clean. Chaos is brewing and we're all standing dead center in the crossfire. Talks between the US and China? Collapsing. Not drifting apart, breaking. Trump refuses to back down. And let's be honest, part of this feels personal. Ever since critics branded him the takeout president, or was it taco president? Something snapped. Now he's out to prove something. That chip on his shoulder? It's turning into a battering ram. Meanwhile, Besson steps in front of the cameras to sell the American dream. Yesterday, he was on CBS saying inflation is under control, that prices are falling, and that everything is fine. But we know better. According to Brookings, tariffs are inflationary, especially for a country like the US, which still imports far more than it exports. That trade deficit? It's not just a number, it's a structural weakness, and the effects are already trickling down. Producers are starting to raise their prices, passing the burden straight to the consumer. It'll take time, sure, but that wave is coming. In Europe, the story is flipped. They're net exporters. So when US tariffs hit, it deflates their economy. They slash prices just to stay afloat. But in America, Walmart can't absorb those rising costs. They're passing them on. Why do you think Trump exploded when reports started coming in? 10%, 20%, even 30% price hikes. There's no smoke without fire. And if that wasn't enough, we're watching a convergence of crises. The Russia-Ukraine war is escalating again. Trump's new bill is about to unleash a flood of deficit spending without breaks, and global commodities. They're shooting for orbit. Copper? Up nearly 4%. Crude oil and gas? Up 4 to 6%. Even wheat and corn are climbing. These aren't luxuries. They're essential inputs buried deep in the US supply chain. Stack all of this on top of rising tariffs, and we're staring down the barrel of structural inflation. No wonder the Fed is frozen. No rate cuts yet. They see what's coming. And now Beijing is firing back, accusing the US of breaking trade rules in Geneva. This isn't posturing. The tone from China? Cold. Final. They're warning that pain is coming, and that they're ready to act. Not just with words, but with economic weapons. First on the list? Rare earths. You probably already know the basics, but here's the brutal detail. China controls 90% of the world's supply of high-performance rare earth magnets. That's 200,000 tons of critical tech fuel. The US can try Japan or Vietnam, sure, but they'll bleed cash doing it. Even the New York Times is sounding the alarm. Shortages are coming. And that's not just bad news for gadgets. Rare earths power the factories of the future. The same ones Trump wants to build at home, using double-priced domestic steel, of course. His new steel tariffs? Going from 25% to 50%. The dream? Bring everything back home. Chips, iPhones, batteries. But here's the twist. Most of these jobs won't go to Americans. They'll go to robots. Reshoring through automation. But automation needs components. And those components need rare earths. If China cuts supply, it's not just human jobs at risk. The entire experiment grinds to a halt. Steel, aluminum, chips. The low-margin industries Trump wants to rebuild, they'll choke on cost before they ever catch a breath. And consumers? They'll be left footing the bill. Now let's be real. Even if the US wanted to play catch-up, it's light years behind. China refines 99% of the global rare earth supply. America barely processes anything. Building from scratch means paying more, much more, and waiting years. In a hyper-connected world, isolation is a trap. Globalization may be messy, but cutting yourself off from it could be fatal. So what happens if China doesn't blink? What if they raise tariffs too? Can the US stomach it? China can pivot. They have suppliers. They have alternatives. But the US? Not so lucky. Trump's effective global tariff rate now sits at 13.1%. That's 6 times higher than when he took office. Even after the supposed truce, imports from China are still taxed at 31%. That means US consumers are paying 13% more on everything from TVs to toothbrushes. Money that's funneled straight into the government's hands to pay for that big, beautiful bill. If you can even call it that. And it's not just numbers. Container shipments from China have been dropping since Trump's so-called Liberation Day. In fact, we're headed back toward the March lows from last year, right when shipping demand should be peaking for the back-to-school and holiday surge. One tariff twitch from either side and that fragile recovery snaps. Supply chains stall. Stores empty. Prices spike. So here's the choice. Does America let Walmart pass costs to consumers, letting the free market work its magic? Or do they impose price controls, leading us down a dark road of shortages and rationing? There's no free lunch. Someone has to pay. And if you think China is bluffing, think again. Jamie Dimon just got back from Shanghai. He's not a man prone to panic. But his warning to Washington? Loud and clear. China isn't scared. So here's where things stand. China has just made 2 critical moves. and neither bodes well for the United States. First, they won't sign any binding agreements. Not now, not during a trade war. Everything will be left in principle, vague enough for Beijing to keep a watchful eye on Washington, ready to strike back at the slightest provocation. And they will strike. We saw it before. When Trump ramped up his tariff war, China retaliated not with words, but by quietly throttling rare earth exports. Subtle. Calculated. Devastating. And now it's the dollar that's taking the hit. Since the beginning of the year, the US dollar has been in freefall, down 10%. That's not just a blip. That's a tectonic shift. For everyday consumers, prices are quietly rising. At the checkout counter, the pain is real. And for foreign investors, even if the S&P 500 stays flat, you're still bleeding. A 10% loss just by holding dollar-denominated assets. That's not just inconvenient. That's a signal. Something's cracking underneath. This isn't about volatility anymore. It's about structure. The dollar has entered a bearish cycle, and these cycles don't reverse easily. Not without a powerful reason. But right now, all we have are structural failures. A ballooning deficit. An escalating tariff war. And a president who's running out of moves. Trump already played the tariff pause card. It bought some time, but that time's running out. He can't raise interest rates. They'd crush the economy and send the consumer sector into freefall. He can't afford another tariff escalation either, not without risking a total collapse of the bond market. That's not speculation. That's Wall Street's consensus. Big players are already positioning themselves. JP Morgan has been bearish on the dollar for months. Now Morgan Stanley has joined the chorus. Their forecast? The dollar will fall to levels we haven't seen since the peak of the pandemic, within 12 months. This isn't vague conjecture, they're naming dates. June 2026, a 9% drop. And they're moving fast, placing bets on the euro, the yen, the Australian dollar. They see it, the cracks in the system, the coming flood. And it's not just the analysts. The entire derivatives market is screaming the same thing. Net positions against the dollar have hit 47 billion. That's not a hedge, that's a stampede. But it gets worse. The dollar index used to follow the 10-year yield. Higher yields meant a stronger dollar. That relationship? It's gone. Now every rate hike only deepens the fear. Markets are no longer chasing returns. They're bracing for a break. The so-called dollar milkshake theory? It's unraveling. Wall Street and Main Street are now so entangled that a shock in one could shatter the other. And the feedback loop is brutal. A falling dollar sparks more selling, which weakens the dollar even further. There's no clear floor, only more chaos. If you can see the wreckage forming, there's still a chance to move. I've started buying international equities. Gold. Because when currencies collapse, capital runs to anything that isn't nailed down. And I'm not the only one. Foreign investors, those managing trillions, are quietly making the same moves. And now the real fear, what if China decides to dump US debt? It's a card they haven't played yet, but it's always there, on the table, face down, ominous. If Beijing flips it over, the Treasury market could implode. Besson would be forced to issue more debt in a market already drowning in it. Add to that China's own flood of debt issuance, the pressure on the dollar becomes unbearable. And where's that money fleeing to? Gold. Again and again, gold. We're closing in on $3,400 an ounce. That's not optimism, it's alarm. Gold only soars when the world feels like it's falling apart. And right now, that's exactly how it feels. Inflation isn't going away. US assets are deteriorating. And the global investment community is losing faith in American exceptionalism. They're pulling back, quietly but decisively. And that capital has to land somewhere. Some of it's going into commodities, some into foreign markets. But a growing portion is heading for gold, the last safe harbor. So watch the dollar. Every new policy, every new escalation, every tweet, it all feeds into the same spiral. Spend more? Dollar drops. Tariffs up? Dollar falls. And the only visible off-ramp is the end of the trade war. But can that even happen? Can the White House swallow its pride and call Beijing with real concessions? Maybe. A call is expected this week. But unless the US is prepared to walk back tariffs, walk back visa restrictions, walk back years of hostility, what's the point? It's honestly amazing China hasn't dumped more treasuries already. But if they do, if that card flips over, brace yourself. Because the fallout won't just be financial, it'll be global. Let me know what you think. How will China hit back? And can the dollar survive another year of this madness? Drop your thoughts below. Stay alert, stay smart, and keep your eye on the storm.